Just checked. We've closed again on a new all-time high. That's one of the bizarre things. I've just made today a ton of money for a rally I didn't believe in, that couldn't possibly happen, to earn the theta to have the long puts, which I'm not needing at the moment. It's absurd, but that's the situation we're in at the moment. Rosie from Rosie.
Holy fucking shit, it's a dinosaur! Jesus Christ, what the fuck?
3, 2, 1. Welcome, ladies and gentlemen, and welcome, fellow colleagues. This is again an impromptu what the hell is going on in the markets, and whom better we would have available than my dear friend Nic Themistocli, portfolio manager, chief investment officer, trader, former market maker extraordinaire with over 2 gazillion assets under management in your heydays, Nick. And that's why I'd like to pick the brain. We have now a fantastic market again, new all-time highs, until Mr. Trump says something, or President Trump will release a new news feed, and everybody's curious. We had this question within our student group. One of our colleagues asked, so have we skipped the week period and directly go into the Christmas rally? Nick, what's your opinion?
Probably is the answer to that. We had a talk, I can't remember, it was maybe a month ago, and we talked about macro, and we said, what's the macro backdrop? And I said, well, I think this is more deflationary than inflationary. I still maintain that, so that hasn't changed. But the technicals are still strong, yeah? So, on the one side, I think, let's just go through the macro themes. I tried to sort of jot some notes here. Economy, I think, is still slowing. I think the employment numbers haven't convinced me that there is any change. I think liquidity is still somewhat constrained, right? So, it's not as if there's an abundance of liquidity out there. There may well be some, in the near future. We don't know what the Fed may or may not do, but they're certainly going to stop QT for different reasons. They already announced that, they kind of pre-announced that they're moving in that direction. Then you've got this thing with private credit where a lot of these names are suddenly in the last month. I think there are 5 or 6 names which have kind of blown up or blowing up, or people are saying, well, it's just a one-off. And then when you look at the markets, you say, well, okay, the bond prices haven't really collapsed that much, but there's fraud in a number of these cases, and these are not small deals, right? And some of these deals they launched 2 years ago at the low, October 2023, and in 2 years they managed to kind of come a cropper. They fraud or bankruptcy or concerns or lack of trust. The sector is certainly struggling. If you look at some of the equity for these kind of private credit houses, they're also kind of underperforming. They kind of have performed over the last years, but in the last few months they have suffered. So there's some stuff going on in the background that maybe you should be concerned about. And then, why was I sort of talking about we are deflationary? Where was you're a madman? Well, because the policies of Trump are there for trying to create a good environment for bonds. And how do you do that? Well, you have to cut the deficit. So if you go out there and say, well, we're going to have lots of austerity, I mean, the economy would go nuts. So how do you do it? You raise taxes through tariffs, and 350 billion, 360 billion a year at a 30 billion month run rate. You multiply that, as I said, over 10 years, that's 3.6 trillion of tax revenue, which is, was not certainly in the planning, certainly not that large. And then you've got the kind of the backdrop of, why does Trump so much want to stop these wars? What's the big deal about it? Because, and as I said this before, I think if you stem the war, you can go then to President Xi and to Putin and say, look, we don't want wars. why don't we all cut our defense spending? And cut the defense spending. You're currently in the US spending 800 billion a year. Cut that in half, or cut that to 600 billion. That's also a lot of money times 10 years. And then, you add these things up, and suddenly this is fiscal, the fiscal path where previously governments, from Obama and Biden, was all about sort of tax giveaways, or certainly giveaways. This is not a giveaway. This is the other way around. So the money is going to come from the likes of Apple. It's going to come from the consumer. It certainly won't come from China. It makes their goods more uncompetitive. It makes it much more likely that people may want to set up shop in America. But at the moment, what it does do is, I think, take money out of the system. What else is he doing? He's forcing a lot of these companies to invest in America. Well, if they invest in America, they ain't doing share buybacks, right? So if you look at the backdrop on all of this thing, you'd say, actually, that's not kind of a reflation state. It may be in the 4 or 5 years down the road, but today that's not necessarily the case. So why is the market rallying? Well, the market's rallying because certainly there's no one willing to sell this thing. So technicals look still remarkably good. Yeah, you don't every time you say, oh, I think it's a bit tired, I think the market might retrace a little bit, you kind of have a small retracement, but then you go back up. And I've looked at charts that, as I say, I've come back from vacation, 2 weeks or 2.5 weeks away, and the market's still just purely on the technicals look still very solid. And I think I overheard you saying 7,000. Yeah, 7,000, 7,200, 7,500 is not impossible based on the charts. Macro aside, because we don't time markets with macro, technically the market still looks in okay shape. But what else looks okay? Emerging markets, Japan, Hong Kong, all of these things that actually I preferred rather than the US have all done extremely well. So I think that's where we are. There are some things that I'm looking at right now that sort of make me say that we're in a very, very delicate position, because the market could really flip one way or the other. That's the dollar, that's the ratio of whether or not money is flowing into the US or into emerging markets. And those will be pretty serious things if they do move a little bit more in the right direction. But I'd say the markets are now sort of fairly delicately balanced because of these things in the background. But in the meantime, stocks go up.
Nick, one question. There is a video one topic popping up all over YouTube, and it's again about the reverse repo facility. That it used to have 2.7 trillion. Yeah, all that money that came in as fresh money during the COVID crisis was parked at the Fed, and now it's drawn down to, 40 billion or 80 billion, something ridiculously small. And I'm trying to get my head around it. What's actually the impact of this for markets? If we're driven by earnings, which seem to be okay, the economy seems to be doing all right. What effect does that have on the liquidity if this 2.7 trillion that came out of the reverse repo is now disappearing? First of all, the question, what is a reverse repo? Because we had this video out a couple of years ago about the plumbing of the market, how it all works. But we now seem to be at these extremes, and guys like Jeff Snyder and all these guys who actually are very knowledgeable are pointing the finger at it and say there could be a big crisis brewing. And I don't see it. What does it mean?
Well, I mean, reverse repo was established to allow kind of financial institutions to put their money to the side. Yeah, so you got excess. I mean, you at COVID time and earlier on, you flooded the system with money. Well, what people can do with the money? They're going to go and buy stuff, right? So the first thing they're going to buy is they say, "Hey, let's go and buy some T-bills." And the problem with doing stuff like that is that the Fed can't control where the interest rates are, because everyone's going to be piling into these instruments, and suddenly these instruments will have an interest rate level due to the sheer volume of buying, placing the cash that's been thrown into the system, and it just wouldn't match with where they wanted interest rates at the time. So they have a facility where they say, look, if you've got some cash, we'll give you some money for this thing, and they use that as part of the steering mechanism for where interest rates should be. Now, at the time when they threw a lot of money into the system, of course, there was as I say, the money has to go somewhere, and the banks said, what, we don't want this money. So the banks basically lent the money to other financial institutions. They went and bought some private credit and all of this other stuff, and that money finds its way into the reverse repo, and that's how this thing went higher. But now the market is, with Fed doing their QT, etc., the reserve balances have come down. Now the banks effectively are saying, well, we need the money ourselves, so they're not lending any more money out. And now their balance sheet sizes, or the reserves, if you like, of the banks, has started to come down as well. So what's happening is that you've moved from, in the old days, 2008, you had a system where rates were controlled by this, what they called scarce reserves. So basically, when banks needed to borrow some money, they go into the market and they say, we bid up reserves, then rates would go up, then Fed will come in and say, that's a bit too high, and then they sort of put some money back into the system. And after 2008, and basically mainly after 2019, 2020, they moved away from this scarce reserves to something they called abundant reserves. And this abundant reserves was where the balance sheets just exploded. So they had, the reserves, and they had these reverse repos and all of this stuff that basically was, a sign of there was no problem with bank reserves. There was no problem with liquidity in the system. But now what the Fed are doing is they're saying, well, actually, now that the reverse repo has come down, what we're going to move to is something called ample reserves, which is sort of halfway house between scarce reserves and abundant reserves. And what that would mean is that's now why they're doing QT, to gradually move the system back where they've controlled the level of the balance sheet. They think the balance sheet size is about the right level. And this is now just another regime, if you like, for the plumbing, where previously it was scarce, then it was abundant, and now it's going to be something in the middle. They wanted to get the balance sheet down because it just was far too high after COVID, after they printed all of this money. And now they're moving back to something which they see as, I don't know, will you use the right words of manageable, but more appropriate, let's just say, for the relationship between the central bank and the banks itself.
Do I get that correctly? In the heydays, all the commercial banks out there had so much cash on their books that they actually gave it to the Fed and got collateral for that, right?
So banks, financial institutions, yes, theoretically, that's exactly right. They
were flooded with cash to the value of 2.7 trillion, which went to the Fed, and now it's gone. Does that mean for me as a layperson that there isn't that much liquidity galore anymore there? That liquidity is deteriorating out of the system?
Well, if you think about what the Fed did around about COVID time, is they printed a shed load of cash, right? Yeah. Effectively, right? So they printed all of this money, has to go somewhere. And, let's go and have a look at where it went to. Oh, the S&P is at new all-time highs. Oh, Bitcoin is at all-time highs. Oh, gold is at. So it's gone somewhere. Of course it's gone somewhere. It's gone into stuff, right? And that stuff has gone up in price. So that's where the money's gone. And now the question is, so did the banks really want all of this money? No. So what they did, as I say, they lent it to these intermediaries, right? They lent it to somebody who said, hey, investors, I've got a great idea. Here's some private credit. We'll go and buy some private credit. We've just borrowed some money from a bank. We're going to go and buy some private credit. Come and invest in our private credit fund. why did that make sense? Well, banks couldn't really do it directly because they'd be charged a lot of capital for doing
Yeah.
it themselves. So these intermediaries kind of it played regulatory arbitrage for it. And that's basically where the money has gone. Yeah, it's sort of come from the banking system out into the big wide world through these intermediaries, and it's gone to buy stuff.
So is there more fresh money left, Nick?
Well, money is there when it's needed to be there, right? The job of the Fed is to sort of look around and say, is the economy growing? Does it need liquidity? They look at the level of reserves. Previously, the level of reserves was set, let's just say, at a percentage of where the GDP was, right? They might have felt comfortable with 20% or something like this. And gradually, this level of bank reserves has come down from X trillion to now it's slightly below, I think, 3 trillion, which is less than 10% of GDP. So the Fed have basically done this knowingly. They basically said, we know that we did a lot of stuff. They won't admit it was a mistake to print all of this money during COVID time. They say, look, we've increased the balance sheet. We don't think that it was the right size for the balance sheet. So what we're doing right now is we're making sure that the overall system has enough reserves for the economy and not enough reserves to go and create another bubble somewhere, another Bitcoin too. So as I say, when money is needed, when the economy grows and there is liquidity necessary because the banks say, oh, we've got a lot of clients who need some money and we're going to sort of give them some money. But by the way, we need more reserves for this stuff. So where do they get their reserves from? They say, okay, let's go into the banking market and go and take reserves from another bank. They phone up another bank and say, hey, how many have you got? And they say, well, actually, I need them myself because the economy is growing. I'm lending some money out. And then suddenly the rates start to edge up. The Fed have a look at this thing and say, well, hang on a minute. We're not ready for the rates to go up. So we're going to put some more, maybe QT or something like this. We're going to put some more money into the system in order to manage the interest rates a little bit differently. As I say, when you're in a system where you've got an abundant amount of reserves, interest rates were controlled was not really the problem. When you were short of reserves, you had some because there was plenty around. Now you're moving to a state where they say, okay, we think we're better off managing it a little bit closer rather than just putting a ton of money in a box and let the banks take it when they want it.
So all these YouTube videos, it's mostly clickbait. It's not like the next big thing brewing around the corner.
So when I said earlier that, there are a number of things that are, in the background not working, things like private credits and so on and so forth, that maybe, everyone says it's a one-off and then one-off, there was a second one and then one-off, there was a third one and fourth and fifth. Maybe there's some more. And if you look at where bank reserves are today, they are sort of very tight. Now, what you're seeing is that there's a spread between the effective Fed funds rate and the interest on reserve balances. And that spread has moved, 3 or 4 basis points. Like, for most people, it's next to nothing, but basically it's a sign. It's a sign to say that the reserves are a little bit tight. And it's a sign to say, therefore, when this spread is starting to widen out a little bit, that perhaps the speed with which liquidity is coming down is more than is appropriate. And you've heard the Fed want to stop QT. So stopping QT is part of this process of moving the regime from this abundant reserve world to this ample reserve world, right? Sort of this halfway house. And then, that's something they're going to have to, tweak. So, all of these people who say it's a disaster and, that things going to fall apart. Well, it may do if the Federal Reserve just look at this thing and kind of ignore when there are signs to say, look, we need more reserves. And I think, the Fed they're not that bad, put it this way.
You threw in this deflation topic. I remember that half a year ago already.
Yeah, probably not half a year ago, but yeah, certainly more. It was basically driven by tariffs. So whenever tariffs sort of came in April, yeah, it's about half a year. My first reaction was, hang on a minute, this is the other way around, right? So I sort of remember doing a chart for a client where if you look at the ISM, so ISM, Institute of Supply Management, survey of the state of the economy, leading indicator, coincident indicator, kind of useful in sort of my history of watching markets. It gives you a good temperature about where the economy is. And so the ISM kind of got to about 50, so it went down. Anything below 50 is sort of economy slowing, anything above is economy growing. So it got to about 50, and what was the reaction from the Fed? QE1. Market goes up, ISM goes back down below 50. QE2. Market ISM goes up, then comes back down, back below 50. QE3. QE4. Tax and Jobs Act, stimulus from Trump 2016. Then ISM goes down even faster during COVID time. So they threw a lot of money at the system. So every time the economy slowed, the response was pump liquidity, QE, 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 QE. At the moment, the ISM is around 49 and 49 a smidge, right? And it's been sort of bouncing along the low levels for a while now. And the Fed have been doing QT. So my sort of thought on this tariff thing is, well, hang on a minute. You're doing QT. So there's no sign at the moment that you're looking to change that in any way. Certainly a few months ago, that was the case. And secondly, what you're doing is you're taking money from the economy, right? So the tariffs come from somewhere. Where does it come? It comes from the importer, right? And the importer then passes it on to, Apple or the consumer or wherever it's going to go. But it's coming out the system and it's going back to government. Previously, the government were the people who are basically saying, here's some money, take it, do what you want with it. Now it's gone the other way. So rather than supporting through, let's just say, this measurement of ISM, could use whatever you want for the state of the economy, rather than supporting the economy through fiscal stimulus, now there's a fiscal drag. So that's why I said, well, if you're going the other way to what you've been doing for the last 10 years, then that's deflationary. That's not the other one. It's a couple of years ago in 2021, it was reflation and buy anything and it's fine. Then we're doing the exact opposite. So that's why my sort of thought was, it's deflationary. Now, might that change? Well, the Fed might respond to something like that. So Trump's going to continue with his tariff policy, but is the Fed going to respond with some kind of, I don't know, adding money to the system, adding, as I said, reserves to the system? We don't know. But until they do, I still think it's the other way. It's the deflation.
So how are we going to get positioned for this market, if you're right, and we have deflationary tendencies in the market? Well, yeah, we have new all-time highs. Everything is expensive. Deflationary topic you brought up, I think there's a real possibility. I heard again this week, house price coming down massively. They already have deflationary tendencies in house prices in the US. How I'm going to position myself in a market that is very expensive? Is it going to get more expensive, Nick?
Well, it gets expensive until it gets cheap. I mean, there's a chart out there you can have a look at, and it's silver, right? So how are you going to position yourself? You're going to ride the wave until the wave says, "Oops, it's going back down." And I think that's basically where we are. There's still clearly, right, in spite of these liquidity drags, in spite of reserves falling, there's money coming from somewhere. If you look at money supply and look at where the money supply is growing, where is it growing? It's coming from China. China's money supply is growing about 8% a year. which is about right for their economy, in my view. This is not sort of excessive. And it's coming from the US, and the US money supply is growing around about 4% a year. Again, that's actually quite low for the US. So the US needs a money supply growth of around 5.5%. And, we've been below that for a while. So, the outlook for me is a bit concerning, but the outlook is not today's market. Today's market, you asked me what I think, I gave you what I think, but the first thing I'll do is I'll look at a chart and say, I think the S&P is going up here. You have to, as I say, you've got to time macro. You can't sort of have a macro view and say, right, there you go. What have I been doing whilst I've been concerned about the US? I think I sort of said it then. I said, hey, I'd rather be in Asia. What's rallied? Nikkei. What's rallied? Hong Kong. What's rallied? Emerging markets. So, they've not done badly. In fact, I think they've outperformed the US market. So in this respect, you can look at other markets, but much more important is really about asking the question, are we entering a new regime? And that's where, I sort of come again back with my charts where I kind of say, maybe not with versus Europe, but potentially versus emerging markets, but we look like we're in a state just before money starts to flow a little bit faster out of the US and into Asia. So that's my interpretation of the charts. It's not a clear win for emerging markets, but it's not been bad for the last few months, I must say. Those are the things I'm looking at.
How does Europe fit into that whole picture?
Well, Europe's a bit of a mess. I'm not sure, where Europe stands. If I looked at just do a ratio or spread or whatever you want to do, SPX and DAX, so you take the SPX total return index because DAX is a performance index. You can kind of measure it against the FX adjusted and see what the performance was. And what you saw was as the dollar started to fall, you had this sort of, and you had Merz, so the German boss, as it were, equivalent of prime minister, I forgot what his role is now, chancellor, something like that. He announced whilst he was in opposition that he was willing to consider opening this debt break thing. So the market went wild and said, hey, you know what? This is another crazy market. Let's go and buy Germany because they're going to, pump money into the system, and what a wonderful thing that is. And for sure, Germany started to improve, the dollar started to fall. So it was like a perfect storm. Great, Europe is outperforming the US. But go and have a look what happened since May. And since May, the US has sort of recovered a lot of that underperformance. Now, the question arises, is this recovery in the US has not fully, recovered what it has lost versus Germany. So like a normal chart, there's been a retracement. It's not a full retracement. So maybe it's just a pause before the US again underperforms Europe. But instinctively, I'd say when you look at the business models taking place between Europe and the US, it's very difficult to bet against the plan of the US versus the plan for Europe. So that's a big question mark. However, as far as Asia is concerned, certainly, for people who've told me, a German politician told me, or former German politician told me, you can forget the BRICS. Well, I ask again the same question, and I don't think he'll be giving me the same answer. I don't think so, because at the moment, what's going on in Brazil, what's going on in China, what's going on in the rest of Asia, what's going on with Hong Kong stocks, I don't know. That one is looking much, much more interesting for me, and that's where I say this ratio, if you like, of how's the S&P performing versus Asia. The Asian markets the S&P has not, unlike Europe, S&P has not recovered any ground. So, that's where I ask myself, is that the new regime? Is there going to be an acceleration of flows rather than just, Asia performs a little bit and then it sort of all goes back to where it's been for the last 10 years, back to America? I don't know. And that's a big question mark. And I don't have an answer. I just say, I observe this thing, I monitor this thing, I put a bet on this thing, but you can't go all in until you've got some kind of confirmation of it. And, it looks good, but it's definitely the thing to monitor. And, I'm not the kind of guy investor who, you suddenly get a call from somebody, like last week, I had a call from somebody saying, I think we should be investing in gold miners. And I was like, oh, no, I think you're a bit late. And I think, I'd rather look for those new themes and those new stories. And I'd rather be early on them, because then you can monitor them, you can sort of start to become a little bit more educated in what's going on there, rather than just be caught surprised, after the market's sort of done what it's going to do, suddenly wake up and say, well, I think we should be doing that. So that's where my focus is right now.
So your ranking is emerging markets, especially the Asian markets, above the United States, and Europe at the third tier.
That's my sort of thoughts today, but I am also chart driven and signals driven, and at the moment, it's looking good, but it's not, done everything to say this is a no-brainer kind of trade.
What do you think about the new Japanese Prime Minister, Mrs. Takaichi? Yeah, I got that.
That's a very good question. I don't know is the answer. So it is my homework for the week, to be honest with you, because I see a number of things that the market has kind of read the new Prime Minister as being another Abe. So Abenomics, let's go and print. Let's cap the yields. Let's just sort of do what was done before. That must have worked because the Japanese economy has improved. Let's just you can't deny that over the last 10 years. And so what happened was the yen weakened more, and the Nikkei's gone absolutely bonkers again. Wonderful. So my question is really, is that what she wants? I don't think so. I think certainly she wants growth. So she's definitely a growth person, but is she really willing to risk the currency? Again, I don't think so. And for that reason, it requires more homework. But at the moment, just looking at prices, I would say the market's interpretation of the new Prime Minister is that she's a printer.
Well, people draw a comparison between Mrs. Thatcher and her already as an Iron Lady. And I like that. Yeah. Well, I was always a big Thatcher fan. If somebody brings a little bit of this spirit into Japan, they could be really onto something again. The sentiment has changed anyway. We called it early, like we did call gold early, and you just threw it in. That's a perfect segue. The miners again, showing off a little bit. Who did call gold 4,000? We did. Yeah,
absolutely. There was a technical level. We broke 2,000. The natural response is to double the price. It went a little bit above that, I must say. It got to about 4.3 or something like this. But
yeah.
Look, it's like an elastic band, right? These things. It gets too far. It comes back to the where it should be. You've taken some of the froth from the silver markets as a result of that, because people who miss gold say, hey, I've got a great idea, let's go and buy silver. I was one of them, right? Early though, enough to say. So we're going to buy some silver now, right? Let's do that as well. That's a great bet. But you get to $50 silver, some catalyst needs to happen in order for this thing to go even more. And I did some homework many months ago to try and work out where is the level of gold? Where should the level of gold be? And I think at the time, gold was around 3,300, something like that. And I tried to look at what level gold was versus, initially I looked at the, not the money supply, I looked at the monetary base, and gold was about 15% of the monetary base. Where is it now? It's 18%. Then I looked at gold versus the money supply back in 1971, when gold was actually backing something, right? So what should the price of, so was it backing the dollar 100%? No, of course it wasn't. So, and similarly today, if you look at where is gold versus the money supply today, it's kind of at levels it's been at before. So there was a, I can't remember, it's a very respected, not YouTuber, but economist, gold 10,000. And I was like, really? That sounds a bit ballsy to me. And that sounds like it's a great call if gold was at 2,000, but when gold's in some kind of hyperbolic move, just launching itself and gold 10,000, it's not a brave bet. It's actually a stupid bet. So, and I've sort of wrote to clients, there are a number of silly bets right now. I think that might be it. And sure enough, that's exactly the kind of psychology you expect at tops of markets. Now, I don't think, at the moment, my sort of outlook on gold is retrace and then possibly rally again. It might get to 5,000 eventually. But, for all of the people who have been sucked into the 10,000 call at 4,300, well, they're going to have some pain for a while and, have to watch this thing for a bit. Silver, I think silver's retracement is more likely to be much deeper. And, my bet has been on copper. So I bought some copper whilst everyone's chasing all of this stuff that's already gone up. I went and bought some stuff which didn't go up. And sure enough, that was a good call in the end. So, and I think copper still has a story. But for these other currencies, what does it mean with gold at 10,000, or silver at $300, or whatever it is? What does it really mean? It means there is no trust in the system, right? Clearly, right? We're back into this hyperinflation kind of world. Are we in that state right now? Is this a war hedge? Is there sort of so much lack of trust that you effectively say we don't trust the monetary system, and you honestly think that the powers that be are just going to say, oh yeah, you're right, guys, go ahead, and they certainly will fight. And I think that the policies of Trump are going, and that's always my whole point about these monetary hedges. He's going the other way. He's actually trying to do something which is going to fix the deficit. Fix is a sort of the wrong word. Not fix the deficit, but it's not going to be something where people are going to be so, all of these charts that even I put out, pre-Trump, where you had the deficit expectations for the next 20 years are just so high. Of course, we looked at monetary hedges. But if you now think, defense spending, possible cuts, tariff income, then you are handling your deficits. And then I think trust comes back into the currency. And for that reason, the question of what do you need the monetary hedge for? I think the question then is, I'd much rather look at where are the use cases? And that's where I went into copper, because I said, well, there's probably a use case for that right now. There's probably a use case for Bitcoin as well as a blockchain, or some of these other blockchains in the future. Perhaps not now, not in this cycle, maybe the next cycle. But that's I forget the question now. That's what's going through my mind.
That's I heard the other day a really comment which stuck with me, and was about the scarcity of gold, obviously, that the marginal buyers are the central banks, which are responsible for the print up we have seen. And the person said, actually, I do not believe in Bitcoin at all when the scarcity argument comes in, because yes, it might be that Bitcoin can't be, you can't produce more Bitcoin, but you can produce whatever plastic currency you want right next to it. Yeah, you come up with a new Doge, you come up with a new stable, So where is there scarcity in the system where you say, oh yeah, fine, there's only a finite amount of Bitcoin, so let's flip to something else and then flip to the next one again. What I'm asking you here is actually the case if we, and I agree with you with gold, even though I'm a big gold bug, and I believe it's not over till it's over, obviously.
Correct.
But the market has been extremely frothy. The marginal buyers filled up to the brim. And as you just alluded to, what Trump is doing, if they get the deficit under control, and we see yields going down, a stronger dollar again, okay, fine. Gold might not double over the next 2 years again. So what's the implication then for the Bitcoin, taking Bitcoin out as the big benchmark? I don't want to call it money. How would I call that actually, Nick?
You call it trust because, you need Bitcoin if you think we're in a world where there is lack of trust in the financial system. You need Bitcoin because there might be a Canadian prime minister or someone like that who is taking your money away from you if you're protesting in a truck blocking a road. I mean, remember that happened. You need Bitcoin and gold when, a government might be freezing the sovereign reserves of a country. So when trust is kind of moving away from the system, when there's a digital currency out there and you're actually saying, well, I'm a bit worried that they force me to spend my money before Christmas, otherwise it sort of has a sell-by date on the digital currency. So you need Bitcoin if you think you need to create a governance and a trust system that is going to be used and accepted worldwide. Now, Bitcoin is probably very inefficient in this regard, and that's why you've got these other coins, Ethereum or Solana or XRP or Cardano, which have sort of spent years trying to develop a governance system so that you can actually say, if you're using this thing, that it can't be abused, you don't have this sort of you have this sort of fail-safe system so that nobody can control the tokenomics of these instruments. So there are other instruments out there that are trying to be more efficient and use if you like, the Bitcoin as the idea, but again, I think these things look like they're taking their time, aren't they? I mean, it's not really something that you see that has reached the everyday person. So it's certainly reached the punters, people like me. But it's not really in the street. I can't go and sort of buy something with this stuff, and there's no government out there saying, "Oh, let's forget about our currency and let's use." Cardano or XRP for this, that, and the other. I think it's probably coming, but today we're not there. And I think there's a lot of work being done in the background. And although I think people criticize blockchain, I think blockchain will do everything. It will replace banks. It will, get rid of all the bureaucracy of real estate and how it's logged and so on and so forth. So I think there is a lot of promise about blockchain. But I hope I'm still alive to reap the benefits, is all I can say.
So if I start now an asset allocation on almost the 1st of November, we're having here. I have a pot of gold here, pun intended. How would you mix it? How much would you put into equities? How much would you put into metals? Yeah? How much would you put into commodities like your copper? What's the role of oil in this whole scenario?
So
how much do I keep? Maybe the most important question: how much do I keep in bonds, and where? At the long end or at the short end? Because people seem to be snapping up the long end with both hands at the moment.
Wonderful thing. I mean, funny in the last talk when yields were about 4.30, I think when we did the talk, and I said, this is going to help 10-year bonds. And what happened with yields? It fell 30 basis points or even more. My current outlook for bonds is that it's reached the target. So I produced a model many years ago where bond yield should be, and it sort of at the start of the year it said 380, And I think yields were around 480 at the time. And it basically stuck to 380 or 388. I can't remember what it was. So it literally didn't move. And it's a macro-driven model. It's just not some kind of Elliott wave thing, technical analysis or whatever. And what happened is bond yields have gravitated right up. And I think this week we saw 390 something, so very, very close to the target. So I think we are at or thereabouts the target. And the question comes, as the Federal Reserve move the regime from this abundant reserves to this ample reserve system, and they stop QT, and where they might feel the need to add reserves, I don't know, to the system through QT, or they may use another method to do that. I mean, I just don't know. That may well mess around with the psychology in the markets and what people might fantasize about. Oh, look, look at the Fed, they're doing a lot of QT. I throw a lot of caution about that. And, if people have suddenly realized bonds are going up, then it's almost certainly time to go and look somewhere else, as I normally do. But I would say the risk for bonds these days is that oil looks like it may have, and I don't know about this, but it may have found a low, right? I mean, oil always had a war premium. They've stopped a number of wars. They've got a big one still to fix. We don't know if they're ever going to fix that or how soon they're going to fix that and so on. But, that war premium on oil may well have, seen itself as done. And if that's the case, then and oil bounces, there's a very strong correlation with 10-year yields and oil prices. I mean, it's inflation. That's all I can say. It's not monetary inflation, but these things are linked. So we watch the way things behave, and when oil tends to go up, then bond yields also start to rise. And for that reason, I would say I throw some caution. There's an argument, as I say, for both ways in this market. I can't really be more strategic than that. I think you need to be a bit more tactical on the 10-year. But I think oil if it has bottomed, then there's probably going to be a lot of pressure on yields to climb a little bit. And if Besant wants to do something with the 10-year and keep the yields down, it's going to have to come up with more issuance of the short end in treasuries and stay away from the long end.
So the long end trade is, I don't want to say over, but
no, it's just difficult, isn't it? I mean, you'd say 4%. Look, I mean, let's face it, 4% yield, right? So you want growth of real GDP of at least 2%. At the moment, of course, we're printing 3.9, I think it is, on the for the quarter expectations. But I think over a year, they're still looking at a 2 handle. See, 2% growth, 2% inflation, you're already at 4%, right? And then you need, some kind of risk premium for this thing. So 4% is about right. And it's probably why my model is already at sort of the 3.8 or 3.9, whatever it was, 388. So it's a kind of the right level. And when something's the right level, it's very difficult for me to say it's cheap or it's expensive.
Yeah.
If it's fairly priced, I'd say, fine, go and look somewhere else.
Yeah, it reminds me of the olden days where we were roughly around these levels, 20, 25 years ago, and nobody actually gave a toss about it. It was, okay, that's where the bond market is, and we work with that.
Clearly. But the people who are concerned about this thing, concerned about deficits. Now, MMT people, rightly have a thing or two to say about deficits. And I have a lot of sympathy with that. In other words, the things you shouldn't worry about necessarily are government deficits. Things you should worry about are sort of private credits. And as I say, if there's been a lot of leverage and there's been a lot of this sort of higher speculation into these types of instruments, well, maybe that's something that we need to be more focused on than, what's the government deficit printing this year.
These we were talking about 2 weeks or 3 weeks ago, these two car part dealers in the United States, private credit, that blew up, right?
Yeah, I mean, I don't know if they're car park dealers or car dealers or whatever, but they probably are car dealers, actually. Some were lending money, I think, to these immigrants who didn't have a job or were trying to get a job or just come into the country. The point is that, what tends to repeat time again, and you see it early. In 2006 or 7, I think it was, there was a company called Cattles that was a PLC, it was a company, public company, and they were just lending money to retail, and they were a quasi bank in a corporate shell, and doing pretty much what these business development companies are doing in America. Well, there was fraud. And when does fraud show? Fraud shows when the economy slows. Fraud shows when liquidity dries up, when you can't get the refinancing. And suddenly, in the case of these car dealers and the like, and I'm not so familiar with the ins and outs, so don't correct me, but the bottom line is people are rehypothecating their collateral. They're basically saying, "Oh, I've got this collateral. All right, we'll lend you money on the collateral." And then somebody else says, we'll lend you money on that collateral as well. Well, he doesn't know about that, and I'm going to borrow money from him as well. And so borrowing the money off the same collateral is like getting 2 or 3 mortgages without telling the different banks that you've got a mortgage with another bank. How can that possibly be? So nobody's been doing their homework. People have sort of been sleeping. There is a case to be said for this is also stupidity from the side of the some of the intermediaries, whoever they may be, and let's hope that's the end of it. But the signs, we just don't know, right? I mean, we are outsiders suddenly reading the next headline saying there's a private credit thing blowing up here, and then you've got some investment bank expert who said, "Well, it's just a one-off," and then the next day it happens again, and you're like, "Well, really?" So. And the same thing, the point I wanted to make about Cattles, that was 2007. What happened in 2008? So these are things that sort of, they're data points, they start early, they're not sort of, hey, let's go and take a trade right now and go and short the market because there's a systemic problem. No, you just say, okay, we note this, and then we're looking out for the next one. And then we're looking for a technical signal to confirm that the market's actually sort of more people than me are worried about it. And that's when you actually sort of have to make the move. But as I say, these things previously happened, when there were, problems in the economy, remember WorldCom and all of this stuff. I mean, not Warren Buffett, it was the other guy, Bernie Madoff, sorry, Warren Buffett, Bernie Madoff, who, it's gradually, there's, as I say, if there's slowdown in the economy, if there's difficulty to get refinancing, these Ponzi schemes, they blow up. And that, you asked me, no, you didn't ask me, but I'm telling you, the reason why I just don't like the MicroStrategy strategy is because if they don't refinance, if they're unable to refinance because it's tight of liquidity, whatever it might well be, well, the whole game is them refinancing and going buying some more stuff. Well, if they can't refinance, then they're going to have to sell some of their collateral, and then then what happens to the value of the bonds they've launched? So again, I'm not the expert on it, but it just seems to me that if other people are struggling with liquidity, if we're changing regimes, and usually when you change regimes, as I say, it's not smooth ever.
A friend of mine once compared that with dynamite fishing. He said, if you throw a stick of dynamite in a pond, you see immediately the little fish coming up dead. The whale underneath is also already dead, but it takes a while for it to float up till everybody sees it. We've seen that in 2000, we've seen it in 2008, and it's because, question now to you as your bond guy, do you see already distress on the horizon in the credit market? Are spreads widening, or is the market completely docile?
I think perhaps I sounded the alarm also a bit early, right? So I saw this 1, I saw the 2, I saw the 3, I saw the 4. It's like, it was looking like, hey, sorry, something is happening. And then we had a lull, right? And you can have a look at double B corporate spreads versus IWM. They're fairly close, right? So the equity ETF for small caps is closely linked to the credit spread for double B corporates, right? So, well, there was this little yield started to rise. IWM, people were buying it, and then spread started to narrow again. So the answer to the question is, at the moment, people are very sanguine. Is that a sensible thing? I don't know, because people are still putting money into the market. Again, what's your upside? What's your downside? The upside is, well, you've got a spread of 3% if you're high yield versus treasury. Is that a good compensation if things go wrong? Question mark. Stunned.
So you're leaving me a little bit speechless, because I'm looking for the trade in this whole thing again. Yeah, we have all these
I'm looking for the trade as well. So
we have all these beautiful instruments lying around. Yeah, when you said IWM, fine, lovely. IWM HYGs against TLTs or IEFs, the high quality stuff out there, because there surely is something there. Because volatility for my levels, on the equity side, we've come down again. The move index is down again. It's this. Everything is so beautiful right now, and then you hear these little things like the car manufacturer suppliers blowing up, just like that.
Well, go and have a look at the credit default spreads of some of these intermediaries that set up and distributed some of these bonds. So first reaction is they're going down. Sure, the equity suffered, but the equity's recovered a little bit. It hasn't gone back to all-time highs like the rest of the market. So again, there is clearly some concern out there, but it's not something that it's like, hey, you're a great person to ask. What happened after Bear Stearns went under? Well, what was the time gap between Bear Stearns and the next one when it really hit the fan?
It's about 6 months.
So, and that's the same thing between Cattles was also 2007, and the beginning of the crisis, or the next domino, wherever that was in the system, Iceland or whoever it was. No, it wasn't Iceland, that was much later. But irrespective, the point being that these are just data points. You put them in your mind, you notice some caution. You'd say, is that really the sector that I want to invest? You look. I think you're going to get warning for disinvesting and selling some of this stuff, but I would say look somewhere else for the investments and look somewhere else for your trades. And as I say, the only thing that I've come up with where I find we are at a very critical level is for the dollar and for the US markets versus emerging markets. There may be other trades out there that are brilliantly obvious to people, but coming back from 2.5 weeks of golfing, those are the first things that kind of hit me, as it were.
So I've just checked. We have closed again on a new all-time high. That's one of the bizarre things. I've just made today a ton of money for a rally I didn't believe in, that couldn't possibly happen, to earn the theta to have the long puts, which I'm not needing at the moment. It's absurd, but that's the situation we're in at the moment. Rosie from Rosenberg Research, he was on a podcast, Thoughtful Money, I think, this week, and he said, we've been now for over 12 months or longer, even 16 months, in a 2 standard deviation from the mean market in the United States on the equity markets. And he said, okay, that can go another 3 months, but in the past, it never lasted longer. And we are these 2 standard deviations away from the mean. And the long-term outlook for that for the next 10 years is actually slightly negative returns for the overall market.
I think that second comment I see as probably likely. But I think the first comment to say, well, we're 2.5 standard deviations and it's 3 months away, that's not something for me. I'd say, I think the 2 standard deviations is the status, that's where we are in the market.
Yeah.
Certainly not a signal to say, hey, you got 3 months before you sell this. Sorry, where does that come from?
Historical data, I checked it. Yeah, it's when you have these two standard deviations, they go on longer than people think they do. Yeah, because everybody's bullish and everybody buys the crap up. But eventually things come to an end. And the other line he brought in, he said, what everybody forgets who's not as gray-haired as we are already, Nick, markets then don't correct by going sideways. When they've gone ballistic.
Yeah, possibly. I mean, the 1960s, we had this sort of sideways market for a long time, and that may well have been I think it was 60s. That's possible of markets going sideways. But I tend to agree that something which has gone a little bit exponential, a bit like gold, does tend to retrace. But there was something I wanted to say about the Rosenberg thing. Oh yeah, I was in a call with probably one of the most sort of well-known traders who's been trading for 50 years. And it was sort of part of this foundation of the study of cycles where I'm part of this working group. And it really is an all-time great. Yeah, I mean, there was this guy, I don't want to name him, Chatham House rules and all of that. But one thing he said was that the most difficult thing is to pick the top of the market. The easiest thing is to say it's the low, right? You say, it's a bit too much. You're going to buy that thing. And historically, that's always been the easy trade. But the most difficult thing, and there is no, 2.5 standard deviation and 3-month rule. There is nothing there that you can hang your hat on and say it works. And it is a very difficult thing. And I know that from an Elliott wave. Some of these classic Elliott wavers from the past have been calling the top of the equity market for the last 10 years. And that's not helped them at all. So the market extends and extends and extends and extends. So, you've got to be really careful about picking tops of markets. And I think they are very difficult to call. And I think, it's a good lesson for somebody who really has been around and traded every single type of market and just basically said, don't even try it.
Yeah, no, absolutely. That's the lesson I've learned as well. Even if you don't believe in it and it doesn't fit your personal analysis of the markets, use the toolkit we have available to at least don't start shorting blindly into a market which tends to go up. And what I find at the moment really bizarre is people are trading moving averages again. You've noticed that as well. Yeah? We're going down to the 20-day moving average that most of the time holds. Then we check out on the 50, that holds as well. Then we directly go up again. People are already talking about buying the dip when we have a 2% correction in the S&P. That also it looks very, this whole stuff works until it stops working.
Well, to be fair, whilst it's not how my signals are created, it's not a stupid system to look at what's called like a rainbow system, where you use a combination of a 20, a 50, 100, or an 8-day 20, 8, 20, 34, I think it is, 50, 100, 200. And you use the system where you actually see when lines are running in parallel, if you like, and without overlapping, then it's a clear trend. That's quite helpful. Whether you're able to use this thing to sort of say, okay, I'm going to buy the dip to 50 or not. I mean, it's not something I do because I'm not always in front of the screen, but some people do that and make a good living out of it. But I'd say the moving average thing, and I remember there was somebody who always called it the moving monkey. But I do have time for some of the analysis using moving averages. So I guess that puts me in the monkey category. But, some people can do it, some people can't.
Don't get me wrong. I think it's a good strategy. You buy the dip and you have a very tight stop underneath, right?
Yeah.
I say, fine, if I get kicked out, I do the same again at the 50. And if that breaks down, okay, fine. Then maybe we'll visit the 200-day moving average in there. I'm just puzzled a little bit about the stupidity of the market. It seems the simple stuff to trade equities, bonds, assets of all classes is now this completely mechanical, okay, yeah, there are the algos in there. They don't want to see that we violate the bottom of last week. and the buyers are coming in, and then we have our moving averages, and otherwise Nvidia goes up because they are printing money in all sorts. Well, they're not printing money, they're printing chips at the moment, right? They have established a fractional reserve banking system. Instead of using money, they're using GPUs, GPIs, or whatever they are selling there. That would actually be my last topic, because I've seen fantastic presentations of this system where they're actually churning again. And you mentioned WorldCom and Enron earlier. They all use these special purpose vehicles which were funded, and then they use the shares to buy more stuff out of it. As long as external money is coming in, and I've actually searched for it, nobody could really tell me how much real fresh money is going into this Nvidia OpenAI circle. Yes, there are funding rounds, but they are tiny compared to the leverage in chips that is employed there at the moment. Is it just me, because I've been around so long, that smells awfully like what happened in the 2000s, or are we having, because the argument against it I always hear is, yeah, but in the 2000s these companies had barely revenues, no earnings at all, and no business strategy, and all these guys out there, they're printing money, so all fine, all good, will go on forever.
Well, yeah, I mean, it comes back down to what do you want to do with your money? And, people have been buying gold and people have been buying silver, and then it's okay, let's go and buy some stocks. And then they go and buy some stocks. And of course, when people buy stocks, they buy in the market capitalization, they go and buy a fund, and then the fund just sort of gives more money to Nvidia. It's not as if Nvidia need your money, right? I mean, they certainly aren't going to say, well, what do we need that money for? They don't need that money at all. They've got enough money. But the question really you're asking is this merry-go-round justified at the end of the day? Does it sort of really, is this something which new money into the system? And I'd say the answer to that question is it's like blockchain. We know it's going to be a lot of promise on this thing. It's a great thing, but would you go and pay $10 for XRP? Probably not right now. There's no sort of proven case. There's the same thing with AI. We know that there's a lot of stuff going on with AI. I mean, this is 10 years hence, it'll be a wonderful thing. But my experience with AI is I get this sort of stupid AI support agent on the phone that doesn't sort of deal with basic inquiries, and then I put the phone down so where is my treat on AI? ChatGPT, as I say, I use it a hell of a lot, but there's an awful lot that it can't do, and it sort of keeps giving me things to do and tasks. I say, can you sort of do this, Sean? Well, if you download that, and if you just then put it on a spreadsheet, and then I'll prepare a chart for you, and I'm like, well, I could do that myself. So the great promise of AI is still to come. And the question is whether or not the returns and we'll only see that with, the revenue numbers that truly come out, whether it's been really justified. I don't know is the answer to that, because I'm too far away from it. But instinctively, my guess is, like most of these things, they tend to take a little bit longer than we think.
I had a nice conversation with Grok and with ChatGPT the other day. Was about option spreads, yeah? And I was preparing a presentation, and I got it cross-checked, and Grok insisted that the strategy I was putting on there was bullish. It was bearish. Yeah? No point about reasoning. I said, no, you're wrong. Grok did not move a bit. Yeah, it insisted on it was right. Same conversation with ChatGPT. ChatGPT wobbled over. Oh yeah, sorry, you're absolutely right. I got that the wrong way. And I thought it's actually interesting to see these, how do you want to call it, characters of these engines, of these machines. One insisting, no, that's what I read on Reddit, and obviously the Reddit guys have to know it. And ChatGPT says, yeah, maybe you're right. I just checked an old book on finance, which says this is correct. What I want to say with that is this: it's extremely useful. It cuts time out of your day. But does it actually really increase the output we are achieving?
So when we reach what I think they call superintelligence, in other words, when large language models move to machine learning, when they're able to learn rather than just go and look things up and be a glorified, sorry about that for all these people, sort of glorified Google or whatever it is you're doing with this thing, because it's just looking into a database. So is it able to reason and that's the super intelligence bit, we're not there yet. So
I did, by the way, I did the first successful little bit of shorting of Google because I thought the whole bloody business model of them seems to be out of the window. Do I still Google stuff? No, I go straight to an AI.
yeah, absolutely. I think that's clear that the choice is now to ask the question elsewhere, because the ability to look through a much wider net and give you good references, I think, is much. I've found it easier and more effective for me. But beyond that, it's, as I say, it's a better Google that I've got.
Because Google has their AI Gemini, right? That's the Google AI, which is on the Google search page, but I haven't found anybody who's actually using that.
I must say, I sometimes incorrectly put my question into the Google, and then I realize when I see what comes up, I sort of quickly go back to the other one because I think it's better. But maybe this, we're now into an area which you're at the fringe of my expertise there, and I use the word expertise lightly.
So good. Then let me sum up what you told me today. There is no doubt that the S&P will go to 7,400. The gold rally seems to be, at least for the meantime, broken. Everybody who wants to go into the miners is a little bit late to the party. We've reached the target level of roughly 4%, below 4% in the 10 years. So that trade is, for the meantime, over. Credit spreads have started to look a little bit wobbly, but then it disappeared again. So we are still very subtle, and there might be a deflationary environment on the horizon.
Yes. And
Good.
And the emerging market versus US is on the watch list.
Emerging markets, United States, Europe at the bottom.
Sorry.
Nick, can't thank you enough for that. So I will switch now the public channel off. I thank you. I thank all our viewers. I'm going to upload that tomorrow. So I'm playing with time right now, because when people that see that, it's already uploaded. I said just tomorrow. It's really one of these fantastic conundrums we play with. Anyway, thank you very much for that, Nick. Thank you very much for viewing us. And tune in for the next video, which will be, I'm working on it at the moment, I'm a bit late, on probabilities of profit, probability of touch, and probability to make 30, 50, 70, 80, whatever percent. And while I was doing my research, I actually stumbled across something really interesting in there. So stay tuned, that will appear on this channel soon. Thank you very much. And now the floor is open for our fellow colleagues.